which is a trade association for crypto companies based in Washington, D.C. And our mission is to change public policy to benefit the crypto industry. And sometimes that involves preventing really bad policies from happening. And I think that's where we are right now. Go ahead, Colleen.
Great. Hi, Colleen Sullivan, co-founder and CEO of CMT Digital. We have a proprietary trading group that trades across global crypto spot and derivatives exchanges. We also invest in the space, and we've been quite active in DeFi, particularly this year.
And I am Jake Chervinsky. I'm general counsel at Compound Labs. Compound is an open source development company in the DeFi space, also the original developer of the Compound protocol on Ethereum. I also have the pleasure of working with both Kristin and Colleen. I'm one of the co-chairs of the DeFi working group for the Blockchain Association, and I also co-lead the regulatory task force for the Chicago DeFi Alliance with Colleen.
Awesome, thank you. Over the past, I'd say week, there has been a lot of rumors about the FinCEN proposal and how it's going to affect DeFi and specifically DeFi startups. So maybe could we get like a high level overview of exactly what has been proposed, what is the effect crypto generally, and then how could it affect DeFi?
Yeah, maybe
I'll go for it, Kristin.
Maybe I'll give a high level overview of sort of how we got to where we were, and then maybe Jake, you can talk about how it impacts DeFi. But yeah, these are the rumors on this started really over the summer, and it was we were hearing specifically that Secretary Mnuchin had become sort of obsessed with this idea that self-hosted wallets are akin to unnumbered Swiss bank accounts, and that something must be done about that. And so that's when we sort of kicked into gear at the Blockchain Association. We put together a report on the importance of self-hosted wallets. But as we were going through the fall, we would hear rumors every now and then about what was going on, but there wasn't anything specific. But starting in November, it became very clear to us that he was looking at a regulation to apply, at the time, limitations to any transactions to self-hosted wallets. So as bad as this is today, which we'll get into in a minute, it could have actually been much worse. But more importantly, he was looking to do this as an interim final rule, which basically means no notice, no comment, no public input, just boom, here it is, and now everyone must comply. And up until a week ago Thursday, about 6 days ago, it was an interim final rule. And over the weeks leading up to last Thursday, there was a pretty heavy lobbying effort. And if we had one small victory, is that we changed the interim final rule to a notice of proposed rulemaking with a 15-day comment period that if you actually count the number of days they give you, it's like 12, because like they can't do math apparently in the government. So, but what the rule does is it requires for transactions $3,000 and up with a self-hosted wallet from a hosted wallet, it requires the MSB to collect and record information, not just on their customer who has the hosted wallet, but they're also supposed to collect the name and physical address of the counterparty with the self-hosted wallet. Above $10,000, it kicks in that there's automatically a reporting requirement to FinCEN. And so what is different here than the way that traditional currency transaction reports work with cash transactions is this collection of information on the counterparty. And maybe with that, I'll kick it over to Jake and he can chime in as to why that's a problem for DeFi.
Yeah, no, it's a really great explanation. And I think, one way of thinking about how this changes the world in crypto from how it works in traditional finance, think of when you go to a bank and you go to an ATM, right? You prove to the bank who you are, that you are who you say you are, essentially by using a debit card and putting in your PIN number. And then you can withdraw cash and there's no other questions asked of you. And up until now, that's how it has worked in crypto as well. You can log on to an exchange using your login and password and maybe two-factor authentication. And then you can withdraw a digital asset, Ether or what have you, to wherever you want without any other questions being asked. The change in this rule would be that the exchange would have to collect the name and physical address of the counterparty to the transaction, meaning whoever owns or controls the self-hosted wallet address that you're withdrawing to. This would kind of be like if a bank made you prove that you owned your pants before you put cash in your pocket or something like that, right? A very different type of rule. I think it's really hard to say how exchanges and custodians and other regulated institutions would implement this rule. That's one of the issues is it's not really clear what kind of diligence would be required to make sure that when a name and address is provided, it's accurate. For example, if you were to put in John Doe 123 Fake Street, would that be enough, or would the exchange have to do some additional diligence? I think that's sort of uncertain. So that's sort of a problem in general. I think the bigger issue for us in the DeFi space is if you are withdrawing assets not to a single self-hosted wallet where there is a person with a physical address whose information can be provided, but instead, let's say you're withdrawing to a DAO, right? Let's say there's a multisig with many different participants who have some element of control over that address. What information do you provide then? And then I think perhaps most problematically, what happens if there is an exchange that has a direct integration with a DeFi protocol, where the exchange is supplying assets to a liquidity pool? Well, DeFi protocols don't have names and they don't have physical addresses. So then the question is, how can the exchange comply with this new regulation in that more complex example of a DeFi protocol?
A quick follow-up question, Jake. I've had a few founders reach out, and they're a bit worried about, the smart contracts where you deposit funds, and that could, whether or not that could be considered, they would have to get an MSB license. They're like looking to understand this regulatory framework in that context. What would be the answer that you'd give to a situation like that?
Yeah, so, well, the first answer I would give is I'm not your lawyer and I can't give you legal advice. So now's a good time to throw out that disclaimer. Nothing that we're saying here is legal advice, just our thoughts on how this rule might be interpreted. So let me just give you some sort of high level thoughts on how that issue might play out. This rule does not change the definition of a money transmitter or a money services business. The rule adds new compliance obligations on already regulated financial institutions to do more record keeping and reporting than they already do. This would apply to transactions between a regulated institution and a self-hosted wallet, or potentially a DeFi protocol. It does not apply to transactions between self-hosted wallets or between a self-hosted wallet and a DeFi protocol. If you have Ether on your hardware wallet and you send it to a DeFi protocol, this rule should not make any difference. Just to back up a little bit, when we think about the question whether a DeFi protocol has some regulatory obligation under the Bank Secrecy Act, the question is whether the protocol qualifies as a regulated financial institution of one type or another. The type of institution that at least is most reasonable to think about applying is a money transmitter, which is defined as an entity that receives and transmits funds from one person to another person or location. In general, the prevailing view in the DeFi space is that protocols are not money transmitters because they are non-custodial. They do not represent a person or other entity receiving funds and then transmitting those funds on behalf of the users of the protocol. That's sort of an open question, and that's something we can get more into, but that's not something affected by this rule.
Got it. Thank you. Now, Colleen, wanted to ask you, especially from a kind of a trading firm and prop trading kind of desk perspective, how do you think this proposed rule affects liquidity providers and investors in DeFi?
Yeah, so, like many things, where you stand depends on where you sit. And so in this context, it's important to keep in mind that CMT Digital participates in DeFi on a proprietary basis. So that means we're trading, providing liquidity, and investing with our own capital. So it's possible that how we currently engage in DeFi may not materially change for us, but I'll caveat that in a minute. We're not an MSB, again, trading prop for our own account. And so in that context, we generally interact in DeFi in two ways. So we typically move assets we self-custody directly into DeFi smart contracts, or will move assets from a centralized custodian or exchange to a self-custody wallet and then into DeFi. Now, if you think about an entity like a hedge fund, right?
Yep.
And let's say that they're managed by an SEC registered investment advisor. That fund is generally going to hold all of their crypto assets with a qualified custodian, even if the assets are deemed commodities. If you take a hedge fund that's not managed by an RIA, that hedge fund is still a fiduciary over third-party assets. And they may feel that having crypto assets with a centralized custodian, qualified or not, is the best way to manage those assets. So in either of those cases, that hedge fund that wants to interact with DeFi, they may not be comfortable moving, they may not be comfortable or even permitted to move assets from a centralized custodian or exchange to a self-custody wallet. So in that case, you would have to, it ends up being problematic because it's not clear, as Jake noted, can that, custodian or exchange KYC AML a smart contract if it can't provide a name or address or anything else that the secretary may require, which is an important part of the proposed rule. So unfortunately, the proposed rule doesn't provide any clarity in that specific context. Now, depending on what the proposed rule ends up saying, one potential way to manage a situation like that would be to move a portion of the hedge fund's assets to an exempt foreign financial institution and then engage directly in DeFi from that FII that's custodying the fund's assets instead of a US bank or MSB regulated custodian. But I use that hedge fund example to help illustrate that if the rule ultimately limits what existing and future participants are able to do in DeFi, well, what does that ultimately mean for liquidity? And that obviously matters to us from a trading standpoint. From the start, we've anticipated that bridges will be built from centralized crypto and traditional finance into DeFi. And we are at the very early stages of seeing exactly that happen. Recently we've seen integrations from Fireblocks, Curve, and Trustology into DeFi. It's unclear how the proposed rule may impact those. And then, Spencer Noon had a great newsletter. It was his December 4th one, where he noted that as of November 27th, the number of unique compound users had grown 290% since the launch of Coinbase Earn Advanced Tasks, and that approximately 174,000 Coinbase users supplied $3 worth of USDC to Compound, representing nearly 87% of all active users. And then importantly, 23,000 of those users supplied additional assets. So that really shows how centralized exchanges can be an effective onboarding user mechanism for DeFi protocols. So that type of liquidity from centralized crypto and eventually traditional finance coming to fruition in DeFi is definitely a component of our DeFi investing and trading thesis. The other obvious concern from a trading standpoint is that for crypto assets that we don't hold in our inventory, we generally acquire them on a centralized exchange. And if the intent is to use them in DeFi, we'll move them to a self-custody wallet like MetaMask. Given all of the ambiguity in the proposed rule, and assuming it remains largely as drafted, it's not unreasonable to expect centralized exchanges and custodians to de-risk and determine that they'll only send assets to hosted wallets, which would mean that we're unable to move assets from centralized exchanges to MetaMask. And if things go that way, will regulated entities continue to support firms like ours by allowing us to move assets to self-custody wallets? And is that even a good thing if they do? Because then that means that, those are sort of private negotiations happening in the dark, right? And in many ways, it sort of feels like the ultimate goal is to use regulated entities as choke points, create a closed loop of hosted wallets held by entities that are regular under the BSA or similarly offshore. Last thing, it's important to keep in mind that trading firms are not tethered to the United States, and many of us also have offices that are not located in the US. So I could see one of the unintended consequences of this rule being that trading firms move offshore. And that's, of course, another significant potential problem. Does this type of rulemaking, where the industry has about 8 business days to comment, drive innovation and other participants like traders and investors outside of the United States? And then from an investing standpoint, the proposed rule throws so much uncertainty into the process, including the need for us to rethink some of our assumptions on DeFi's total addressable market. Our vision is that protocols like Compound end up being integrated into both centralized crypto and traditional finance, And we, of course, anticipated grappling with regulatory issues along the way as those foundational DeFi protocols scale. But we did expect to have reasonableness and time on our side, especially given that so many of our regulators in the US have put a significant amount of time into understanding crypto and working with us, which, Kristin and Jake can both attest to. If the rule remains largely as it is, what type of de-risking are we going to see? How do we anticipate what will go on in the ecosystem, and what kind of a chilling effect would that have? Also, as investors, we're very excited about non-financial use cases in DeFi. And it seems that the crypto assets that will be used in those economies will also be potentially pulled into these record keeping and reporting requirements, which really doesn't make, all that much sense to us.
Thank you for that, Colleen. Now, it seems that this policy came out in a hurry, and there wasn't much nuance in terms of how it affects crypto and DeFi generally. So, what is the mental model of a regulator, and why was this what do they want this to apply to? Is this purely based on KYC AML? They want to make sure that bad participants aren't money laundering or using this as a way to money launder into protocols and crypto assets generally. What was the mental model of a regulator, and why was it hurried in an instance like this?
I mean, just using the phrase mental model makes it sound like there was a lot more thought that went into this than there is. But and I want to be clear, this is not being driven by FinCEN, even though the rule was issued by FinCEN. FinCEN is incredibly sophisticated on these issues and they have done a tremendous job working with industry and having open dialogues to try to understand this space and figure out the right way to apply regulation. And I think the guidance that FinCEN issued, I think it was back in 2013 and again in 2019, really did have a thoughtful approach. And there was a tremendous amount of work that went into developing that guidance. This is being driven by the Treasury Secretary, Secretary Mnuchin, and he is done with his job at noon on January 20th with the end of the Trump administration. And so in his mind, he thinks crypto is only used for speculation, and it's primarily used to facilitate illicit financial activity, specifically money laundering, but potentially terrorist financing and other activity as well. So he wants to stop that. He wants to be the good guy who comes in and solves this problem by putting this regulation onto it. And he thinks self-hosted wallets, he does not understand that they have any other purpose other than for criminals to hide money without having to have KYC done. And so that is obviously not accurate. I mean, yes, there, like any technology, there is criminal use of it. And I think crypto in particular, with the blockchain analysis firms, have done an amazing job in helping law enforcement track down bad guys. So, I think there are different types of tools we should be talking about when they want to, maybe find new ways to empower law enforcement. But so this is, I mean, the words, the name and physical address of the self-hosted wallet, that is a specific request of the secretary. Like that is him wanting this, and he has been incredibly involved in trying to get this done. So his mental model is he wants a victory before he leaves, and so he is trying to speed this up as much as possible, because this is such a complicated space, and there actually might be some very good reasons for having more of a traditional currency transaction reporting regime. And I think the industry is open to talking about that. We're also open to looking at ways to further empower law enforcement. But right now, this is not being driven by the experts that have actually spent all of the time researching this space. It's being driven by a very busy Treasury Secretary who has somehow, in the middle of negotiating the CARES Act and everything else that's going on in the world, also seems to be spending an unusually large amount of time trying to rein in Bitcoin and cryptocurrencies. And he doesn't know what DeFi is. He has no idea what DeFi is. That was not contemplated whatsoever.
That's exactly the point I wanted to add, which is just to give some context about what extent this rule is targeted toward DeFi. I think, first of all, I want to reinforce what Kristin said about FinCEN. FinCEN has actually been extremely constructive and supportive of our industry in general and of DeFi in particular. So the view I expressed earlier about a truly decentralized and non-custodial protocol not qualifying as a money transmitter is something we get from FinCEN's guidance from May of 2019, where they actually discussed decentralized exchanges and basically said if a decentralized exchange protocol is simply providing a forum for buyers and sellers of assets to meet each other and conduct peer-to-peer transfers that are not executed through some centralized party in the middle, then that decentralized exchange protocol does not represent a money transmitter. That's a pretty amazing thing, frankly, for a regulator to say. It is very rare for regulators to come out and say, here is the limit of our jurisdiction. Here is something that we will not go after. We, for example, never see that from the SEC, right? The SEC will always tell you what it thinks is a security, and then also everything else in the world could be a security as well, including stablecoins, right? So FinCEN is, I think, uniquely supportive in favor of innovation among the regulators that we deal with. This really is coming from the Treasury Secretary. In his mind, a self-hosted wallet is a Swiss bank in your pocket. And that to him is fundamentally unacceptable. That is a financial system that he believes on principle cannot be allowed to exist. And it really is a personally driven issue for him. I don't know if he knows what DeFi is, but the rule certainly is not drafted to apply to DeFi. The rule talks about quote unquote unhosted wallets, which it describes very much in the sense of a single private key that is being held by a single individual or company. There is no reference even to a multisig, let alone a DAO or a DeFi protocol. And I think for that reason, this is one of the many reasons that this rule is so poorly crafted and why we should be so aggressive in opposing it. It is very unclear whether the rule applies to a DeFi protocol at all, or if it's drafted in such a way that it would only apply to a single private key self-hosted wallet. The problem, and this is something that Colleen mentioned, is de-risking, which, to give you a little more color on that, is when a regulated institution says, we simply do not know what this rule requires us to do. We are afraid that if we conduct some type of activity without certainty that we are in compliance with the law, that we will get tagged for a violation. So even though in theory, we know that it's possible we could comply, since we're not sure how, we're just going to stop doing this activity completely, because that way we can be totally sure that we're not committing a violation. And I think that the concern here is that a rule that is so vague as this one would lead to de-risking of DeFi. And that's one of many reasons, like I said, that we should be opposing this vigorously.
Yeah, and it's a different context, but just to highlight the de-risking point, we're seeing it happen right now with Ripple, right? So the SEC came out with their complaint yesterday. We've seen a couple of exchanges delist the asset. Bitwise did the same thing with its index earlier today. That's an example of de-risking. We don't know ultimately if the SEC will prevail or not, but there's just too much risk in dealing with what could be an unregistered security. So regulated institutions are going to take steps to protect themselves from that uncertainty. So it just kind of highlights the issue.
Thank you, Colleen. Now, Kristin, what are the lobbying issues today and the lobbying efforts that you've made over the past, 6 months? And going forward after transition, would love to learn more about, what are some of the strategies you're putting into place?
Yeah, so we sort of have a three-phase strategy for dealing with this. At least we have been since we realized it was an interim final rule initially proposed a couple of weeks ago. So the first phase is really a lobbying phase, right? This is what can we do to throw sand in the gears to slow this thing down? And that involves all sorts of things. It involves getting executives into meet with various senior people at Treasury. It involves getting letters drafted from different people in the community to show our opposition. It involves getting on the phone with the White House offices to try to get them to slow it down. It involves working with members of Congress to get them to write letters or lob phone calls into the Treasury Secretary to tell him that process is important here and that they need to slow down. And so, as I mentioned at the beginning, we actually did succeed last week. There was enough pressure on Treasury that they converted this from an interim final rule to a very truncated notice of proposed rulemaking, but at least there was an opportunity to provide comment. Those comments are due, as I mentioned, on January 4th. And so we're in the process right now of developing our comment letter on behalf of the Blockchain Association. I encourage everyone to also send letters, whether you're an individual, you can go to like fightforthefuture.org and they have a form, or if you're with a company, you can provide comment to FinCEN. But the lobbying effort is continuing right now, right? Because 15 days or 12 days or whatever it actually ends up being is an incredibly short amount of time to provide substantial comments on something that is so complicated. And especially given that it's Christmas Eve, Christmas, New Year's, also happens to be my birthday. They didn't take any of that into account. And so we are continuing to put an immense amount of pressure on Treasury to get them to convert the time frame from extend it from the 15-day period to like a 60-day period. So we've been working with everyone in industry, and there's a good effort going on. So, you know, Coinbase, who is not a member of the Blockchain Association, but very active and doing a great job on this issue, they sent a letter to Treasury on Monday. Yesterday, you had Coin Center release their comments early. And, you know, basically came up with an incredibly amazing and creative way to get standing for them to bring a lawsuit if the rule goes into final effect. So that puts on more pressure. We are right now working on a letter from the Blockchain Association's counsel, Paul Clement, that we're going to lob over into Treasury next week, arguing a very detailed analysis on the process side. We've got several members of Congress that are looking to do another letter. And we've got some very senior members in the Senate that are working to get phone calls with the Treasury Secretary. So our hope is that if we continue to put this increased pressure, that he will potentially, you know, realize that he can't sustain that and extend the comment period. So that's phase one. Phase two is if this rule goes final, we're going to file a lawsuit. As I mentioned, there's a couple other entities out there that are looking at lawsuits. Jake is leading up our effort with the Blockchain Association, having his amazing litigation background. We're working with Kirkland and Ellis and Paul Clement, and we're going to do a challenge basically on process grounds that you can't do something that's big with just 15 days, that is a violation of the Administrative Procedure Act. So that's sort of phase two. And then phase three is a little bit more amorphous. It's really get this into the next administration, evaluate who the players are there, and figure out a strategy for pulling it back. And so that'll come, I think, into focus. But right now, most of our efforts are preparing for the legal challenge and then continuing to apply as much pressure as possible on the Treasury Secretary.
And just kind of like delving down, what are like the policy arguments that we're making and that you're making?
Yeah. So I think they fall kind of roughly in three buckets. And you have to remember when, you know, we're dealing with members of Congress, I mean, there's obviously the process arguments, but on the substance side, one, there's a compliance argument that this is way too much too soon for MSBs to be able to pivot and implement this type of compliance, right? I mean, they have to come up with a whole regime for collecting names and addresses of self-hosted wallets. It gets very complicated if their customer is actually the recipient. When do they provide that information? How do you get that? That's a process that our MSBs would need to figure out. There's also a major privacy argument, right? Like this goes way beyond what the Bank Secrecy Act does today and requires records and reporting to government of parties that are not customers of these financial institutions. And it creates immense security problems of having blockchain addresses, matched up with names and physical addresses located in a government database. It gives them access into all sorts of information that today they would have to have a subpoena to get. And so we think that, there are a lot of folks on the Hill in particular that are very concerned about the financial privacy aspects, and that is that is a very important line of argument. And then kind of the third line of argument is that this prevents the development here in the United States of the next generation financial services, so DeFi protocols, and Web 3.0, as I think Colleen alluded to earlier, that if we want the US to be the leader, we need to be able to have consumers access these protocols. And so that there's sort of this like US competitiveness innovation argument that seems to be working well with the members of Congress in particular that we're speaking with. So those are sort of the three basics. I mean, there's obviously a lot more detail there, and we're working to get that pushed out, but there's only so many hours in the day right now.
And I guess, like, you know, a final question on this topic is, how do you like change the mind of people, right? Especially given the fact they come from this kind of very traditional financial background, and we're coming from this more of this new, you know, paradigm where we see, you know, DeFi and general crypto kind of changing the way financial markets work. And you're like right in the middle. And like, how do you think about that? And what are you thinking about in terms of changing people's minds?
You know, it's really hard. It's especially when somebody is dug in. When you're working with a policymaker who's sort of coming at this fresh and is trying to figure out both sides, it's a lot easier to sort of get in the mind first. But this is with the Treasury Secretary, you know, he's a difficult man to get to. He's got a lot going on, unlike a member of Congress where I could show up at a fundraiser and have a conversation. It's hard to get in the room with the secretary, right? And so a lot of it relies on finding people who know him well and trying to understand his mental state. It's trying to understand what motivates him. He has very different motivations, I think, than maybe other policymakers who are trying to leave government, who might be trying to figure out what's my next job, how am I going to make money? This guy's got a lot of money, so it's not motivated by that. But yeah, you have to look at people's background. You have to figure out you know, who does he know and trust that we could get to that could get to him. And so yeah, it's trying to get into the psychology of a given person. And this one is very very different. You know, with members of Congress, there are, you know, with members of Congress, there are more traditional ways. You know, it's relationship building, it's, you know, participating in fundraising, it's having really good arguments that appeal to them, it's having an element that their voters care about. But yeah, trying to influence the Treasury Secretary is a totally different ballgame. So we're throwing everything at it that we can possibly come up with.
Yeah, and
Thank you.
Imran, real quick, you know, you said something that I think is important to highlight. You noted that it's a new paradigm, right?
Yeah.
So you're trying to take people who are used to the way the traditional financial system works and have them reimagine what can happen in a decentralized manner with these new systems. And that's a really hard thing to get people to do, because you're so stuck in thinking in the context of what you know. And I think Jake or Kristin raised the point earlier too, is, you know, how many of our regulators and policymakers, and certainly the secretary, are actually experimenting in DeFi right now to start to understand what's happening in that space and the potential. Because as you start to abstract away some of the complexities, you improve UI, UX, we finally get to better scaling solutions. We do get to that point where it's going to be easy to onboard people who have traditionally been excluded from the financial system. And that's why I think it's so important too that, you know, the industry realizes, everyone on this webinar, the work that people like Jake and Kristin, the Chamber of Digital Commerce, Coin Center are doing on behalf of the industry in the background to protect these systems while they're still so fragile. I don't know that that kind of work gets highlighted enough. And you know, it's great that Kristin and Jake are willing to share, you know, what they've been doing and the challenges they faced. But, you know, we all knew it was going to be hard to try to democratize money itself and financial products and services. And that's what we're grappling with. But I do think ultimately, you know, DeFi will prevail here. I have no doubt. But I do think it's just so critical to understand, you know, what these guys are doing behind the scenes to try to make that happen.
A lot of our work within the DeFi Alliance is to bring market makers and trading firms and institutions into DeFi, both from an educational perspective, along with being able to provide liquidity and or investments into some of these emerging DeFi protocols. Now, with this regulation in place, what would institutional DeFi adoption look like moving forward?
Yeah, I'll just throw in a couple of thoughts. I think it's very hard to say. I mean, I think that is one of the big problems with this rule is it is very hard if I'm imagining myself as compliance counsel at a regulated institution. So I'm very curious to hear what Colleen, thinks about this as well. It's very hard to say what my advice would even be. And really, this is the problem with bad regulation. The truth is that in my mind, a regulated institution, a trading firm, a liquidity provider, they don't mind complying with regulations. They just want to know how they can do it. The most important thing is to have clarity about how to comply. And when you have rules that are by their nature extremely uncertain, that are going to put us back in one of these worlds where every single business has to go to the government and ask questions behind closed doors to try to get some clarity just for themselves about what they can and cannot do, that is an environment that chills business activity. That's the kind of environment that sends companies to other jurisdictions where they don't have to be so concerned that one day a regulator is going to show up and say, hey, you shouldn't have been doing this or that. And even though we didn't tell you, and even though it wasn't clear from the rule, now we're going to get you involved in some long investigation or enforcement action. So I think this is sort of a way of answering your question by not answering your question, but it's very unclear, I think, how regulated companies could figure out how to comply. I guess just to throw in one final thought, I do think based on the language of the rule as it is, there's basically two views that one could take. One is DeFi protocols are not unhosted wallets. The rule applies to unhosted wallets. DeFi protocols are a totally different thing. Most of them don't even have private keys in the way that the rule describes. So the rule doesn't apply to DeFi protocols. And if the government wanted the rule to apply to DeFi protocols, it would have said so in the rule. So this just doesn't make any difference at all. I think that's one view. That would be a more risk tolerant view. The risk averse view would be to say, the rule does apply because the rule requires institutions to collect the name and address of the counterparty to the transaction. And in theory, every single other user of a DeFi protocol could be viewed as a counterparty to every single transaction in that protocol. I think that's kind of silly, but if you were to take the risk averse view, then what you might say is, it is possible the government could interpret this rule as requiring us to collect the name and address of every single user of the protocol. And since there's no way for us to do that, we simply can't allow any transactions with that protocol. So that would be the de-risking, the very risk-averse view. And I think there may be many other answers that fall in between or outside of that range, but that's sort of my preliminary thoughts there.
Yeah, I don't have much to add to what Jake said. I mean, he said exactly what I was thinking. I mean, it's really hard to say. And I think maybe a decent case in point here is Bitcoin. I mean, Bitcoin, it has a regulatory mode around it. It's got tremendous infrastructure around it. It's got a lot of buy-in. It's highest on the market cap. But a lot of regulated entities, institutions were hesitant to go into Bitcoin. And it was kind of Paul Tudor Jones that started to change that narrative. Okay, well, now it's safe. At least I'm not going to get fired because Paul Tudor Jones did it. DeFi is going to have to kind of fight those same battles where it's, as Jake said, it's the compliance officer, it's the operations department. They may not necessarily be tied to the trading desk's P&L, right? They're compensated in a different way, and they're compensated in many ways to protect the firm. So there are different incentives there, and it's easier to say no until that path is kind of paved.
So if I'm a startup founder building in DeFi, should I be worried about what's happening?
I wouldn't be worried. I would be motivated to get involved. So I think that what founders should do is not get scared, but get active. And what we can do right now, starting today, is to submit public comments, and maybe I'll let Kristin jump in on the best way of doing that. But it is extremely important that we make our voices heard. The more people who speak up, the better we're going to be able to defeat this. So don't be worried. We're going to be fine in the end. We have a lot of really smart people working on this. We need to fight for this. It will not happen on its own. We need to get active.
Yeah, and I will dig up the link to the proposed rule, but basically there is an email comment process. So there's sort of two comments, a couple different ways you can make comments right now. One, if you go to Coin Center, they have an easy way for you to get an email over to the Treasury Department. This isn't a formal comment, but this is an effort to lobby the Treasury Department to get them to slow this down. So I will dig up that link and get that in the chat here shortly. The other is to get comments on the proposed rule in the FinCEN. So the Fight for the Future link I just sent around, the stopfinancialsurveillance.org, you can go in there and that'll get a sort of form letter comment into FinCEN. That's important because that will increase the number of comments. So it'd be great to be able to say, hey, 10,000 comments were filed on this, that people are concerned about the process. Oh, thank you. Yeah, there's the Coin Center link in there right now. Or the other thing that is helpful in addition to getting volumes of comments on the rule is getting really unique substantive arguments in, because the Administrative Procedure Act requires that FinCEN address all of the concerns. And so if this thing goes final and we can go through and say, hey, FinCEN, you didn't actually like address this particular question in the final rule, then that will help us with our like legal challenge that we have after the fact. So it's also important when you are though doing these more substantive comments to also complain about the short process period, because that also helps with our legal challenge if we end up having to go that route down the road. So I'll just dig up the link to that real quickly.
Thank you. Now, there's some like obviously nuance to DeFi generally. Wanted to ask, like, how does this affect multisigs, DAOs, and complex transactions?
Yeah, sort of the same answer, right? Who knows?
Yeah.
I think again, it ends up being up to the regulated institution to decide how much information does it feel like it needs to collect in order to be confident that if FinCEN comes asking questions, that they can show that they've done what they needed to do to comply with the rule. When the rule says collect the name and physical address of the counterparty to the transaction, I think what is uniquely confusing about that when it comes to a multisig is which person in the multisig is the counterparty to the transaction. Is it all of them? Is it a majority of them? Is it just the one person who requested the transaction? What amount of information does the institution have to collect? What happens when the majority of the multisig holders are anonymous, right? Who is going to submit that information? So it may be that, if you are a customer of an exchange and you withdraw to the multisig, you're the one who's going to get asked to supply that information, right? What if you don't have that information? It also could be the institution could say, look, we don't feel like we've done enough diligence if all we do is ask you, the customer, to provide information. What we really want to be absolutely sure we're not going to get in trouble is full KYC for every counterparty, the same as we would have if the folks who are going to be in control of this, this address where we're sending funds were our own customers. So have them get in touch with us and have them give us their passport and their social security number and all their other information, right? If an institution said that, I think it would be unfeasible for sure, and also a massive infringement on financial privacy rights. But those are the kinds of very confusing, uncertain discussions that will happen at the highest levels, among executives at these institutions to figure out, how do we comply with this rule? Or is this so confusing that we're just not going to allow withdrawals to multisigs? Yeah. We're not going to do integrations of DeFi protocols because we don't know how to make it work safely.
Thank you, Jake. And a final question before I ask a few questions from the audience is, does this drive development outside of the US? Is this beneficial for regulators? Who does it benefit at the end of the day? And will, at the end of the day, like a lot of the development that's happening in the US move outside to other countries?
I mean, I think if this rule does go into effect and we aren't able to either slow it down or have a successful legal challenge, I do think it drives people overseas. I mean, it's just the environment here it would make it, I think, very difficult to operate, and it would just be easier to do it overseas. But I mean, that I certainly hope that's not what happens. I hope that it stays here, and because, you know, from a policymaking perspective, our best tool we have in advocacy is when you have a bunch of businesses and consumers actually using these. And if we drive all that overseas, then I will never get the right policy here. So it's sort of a circular sort of spiral going in the wrong direction.
Yeah, and I'll just add, I mean, to a certain extent, we've already seen that happening, just given some of the, you know, unclarity and ambiguity we have from the SEC in particular. You know, we'll talk with teams in Singapore and Switzerland, and they're US citizens, you know, who've decided to go to different jurisdictions to build. To the point Jake made earlier, it's not that people don't want to comply. They just need a roadmap to tell them how to comply. So you want to go to a place where those things are clear. So I think, unfortunately, if this does go into effect as proposed, you know, I agree with Kristin's comments very much. And of course, that's not what any of us want. I mean, we want to participate in this new technology like we did with the internet, and there's no reason that we shouldn't.
Now, a question from Ian, and this is for Kristin. Can the Blockchain Association publish some sort of document making clear what parts of the proposed FinCEN rules they support or oppose?
Yeah, we are working on that right now. It'll probably in the form of our comment letter. We do have some documents that we put together prior to the release of the rule, but we haven't published anything since then. Part of the reason we aren't able to turn that around super quickly is that our positions are reflective of our member companies. And so we need to spend some time talking with everyone and making sure we have the right pieces together. But that is something that we will definitely get out the door before the January 4th deadline. And we may even start piecing it out in advance of that. But I'll send the link to our website that has the information that we do have. But yeah, specifically to this rule, stay tuned.
Should there be a SAR or SAR report generated for wallets sending greater than $10,000, and should exchanges be responsible for these reports by mandating the use of blockchain analysis? Was a question asked by Ian again?
Yeah, I mean, I think so. The above 10,000 threshold is for a currency transaction report, as opposed to a SAR. Though I might not be the one to get into the details of how those work, but you know, if there are some out there that have the mindset that we should try to have parity with cash for crypto. It gets a little bit complicated because they really are two different things, but the equivalent in this case would be if I want to take $10,000 and move it to any self-hosted wallet, there's just a report that goes in that, hey, I moved $10,000. And that would be sort of the equivalent today of me going to the bank and taking out $10,000. So if we want true parity, just having the information that I, Kristin Smith, requested this transfer, that would be the closest thing to parity. What's different today is that as we were talking before, it now requires me to tell me where I take those funds, and that is just a different level that goes far beyond anything that exists in the traditional world today, traditional financial services world today.
A question
what was the second part?
Oh, the second part is, give me a second here. And should exchanges be responsible for these SAR reports by mandating the use of blockchain analysis?
I mean, I think most of the exchanges do use blockchain analytics, and law enforcement do as well. So I don't know if that's mandated, but I think that's part of what is their their risk-based you know, compliance programs that they have today.
Question from Sanina: do we think the incoming Treasury Secretary Yellen could simply reverse the rule? Should we be lobbying the incoming team?
Yeah, I think that we can get this reversed in a new administration. The question is going to be, if it's an open proceeding, and it hasn't been finalized yet, then the regulators can decide to either pull it back or slow it down or reissue it in a different form. The challenge is when the rule becomes final, just procedurally, it takes a lot longer to undo something like that. And you know, it's for those who don't know this space very well, the optics of this are, oh, we're empowering law enforcement with all of this important information. And I mean, once something goes into effect that has that messaging with it, it becomes much more difficult to undo. So, so yes, I think we can get improvements under the new administration, but depending, that could be hard or easy depending on if the rule if the rulemaking is still open or if it's final.
There's a saying, laws are written in ink, they're hard to erase. Right. So we yeah. Ideally, we will stop the law from going into effect. Life is so much easier if we can. I think it's basically guaranteed that with a fresh administration, we will have a new process, a clean slate, as long as the rule is in effect. If it is in effect, that's not to say that all hope is lost. There are still arguments we can make. I think we have very strong grounds in terms of the litigation that we're thinking about bringing. But this is why it matters so much for us to be active in the next 11 days or 12 days, you know, however long we have to submit public comments and try to stop this law from being written in ink.
Cool. Those are all the questions that we have. But any final words from the panelists?
I mean, I always have to put in a plug for the Blockchain Association. You know, if you're a crypto company and you're in this space, we have an amazing group of companies that are working together to try to get ahead of these issues and prevent these bad things from going into effect. And we have an incredibly small but talented team, and I would like to get more boots on the ground, more resources in place so we can be more effective. So that's my plug for joining the Blockchain Association.
So I was actually about to make the same plug because
hey,
obviously, yeah, look, you know, you guys, those of you who have listened to this, it should be obvious to you how talented Kristin is and how experienced she is. We are so lucky to have her. She is, I think, the unsung hero of crypto policy in DC. We would be lost without her. And I feel privileged to get to work with her, that she takes my calls no matter what time of day it is, even though I am awful at responding to you know, messages, she'll still talk to me. It is so well worth joining the Blockchain Association if you care about the future of policy. And I think my parting message here is, this is a very stressful time in transition. This is a really tough fight that we have to have for the next 28 days or so. But this is not the end. This is the beginning. This is a fight that we're going to have for years to come. The more crypto emerges in general as an important element on the geopolitical stage, on the macroeconomic stage, the more there are going to be policymakers who are concerned about it and who want to, like Secretary Mnuchin wants to do, to regulate it in a way that is not beneficial to anyone except perhaps the legacy financial system that we are trying to improve, that we are trying to remake. It's never easy to disrupt a system that is entrenched as this one is, and we are going to need everyone to be engaged in this fight. You know, there are a lot of folks who have more of a, you know, a cypherpunk crypto anarchist view on this. And I totally get that. I love that. I identify with that, but we can't just ignore policymakers. We have to engage. And I think the best way to do that is by considering joining the Blockchain Association. So Compound Labs is a member. As I said, I am co-chair of the DeFi working group. I would love to have more folks who can help me work on those issues. And so, you know, please reach out if you're interested in joining, and we can get you more information about that.
Thank you, Jake.
Yeah, and Imran, I'll just add, I mean, I think, you know, part of the reason that Jake and Kristin and others like us have been working with policymakers and regulators for such a long time in this space is because we all knew that as these systems scaled, fear would be a fast follower, right? And that's what we're seeing. And I couldn't agree more with Jake that this is just the beginning. So I really wanted the industry to see the work that the Blockchain Association is doing and other industry groups behind the scenes, working on their behalf day in and day out. There is so much happening. And getting involved with these organizations really is critical, because what helps Kristin make her case, you know, working with Jake can provide her with statistics. This is what's really going on in the protocol, and just kind of create that feedback loop. It's so important. It cannot be understated. And as we go into this new administration, it's going to be incredibly important for us to actually show, not just talk about, but show how these systems are making meaningful differences in people's lives. And that's where industry, working in collaboration with the trade association like Blockchain Association, that's opening those doors to get into the policymakers and the regulators, is just so critical.
On behalf of the DeFi Lines, Kristin, we thank you so much for all the work you're doing at the Blockchain Association. We love you guys.
Yeah, no, thanks for having us today. I thought this is a great conversation, and hope everybody gets their comments in so we can push back on this.
Will do. Thank you so much all for joining, and we'll post up the recording in the next 24 hours. Thanks.
Thanks,
Thank you.
everyone.
Awesome. Thanks, guys.
Thanks. Bye.